Good afternoon, everyone. As of recording, the stock market is in the red. But looking out over the past 6 months, you could see that stocks have significantly recovered since the tariff threats. This may give investors a feeling of confidence. You might feel happy that stocks are going up. You might be ecstatic that you're outperforming the indexes. However, it's during times like this we have to be critical and take an outside look at our portfolios and see what we could improve upon and grow upon as investors. I myself have been finding it extremely difficult to find value in today's market. And for that reason, I'm going to be sharing 5 stocks that I think are buys in the market today. For those who don't know me, my investing strategy revolves around buying the highest quality businesses at some relatively fair prices. I look for companies that could only be described as compounding machines, companies that grow their intrinsic value year after year, that grow their earnings, do buybacks, pay dividends, and are all around fundamentally strong. Companies with the best fundamentals on the market. With that said, I'm going to introduce you to my first pick and probably a stock you've heard about a lot lately. Amazon. I probably don't have to give you a rundown of what Amazon does as a business model, but Amazon is the leader in the e-commerce sector. They sell goods online and also have growth in the advertising and cloud sector. Now, Amazon is a very interesting business because it doesn't appeal to the average investor. The average investor wants businesses that focus on earnings now. The average investor looks for businesses that pay a dividend and reward shareholders in the moment. They look for businesses that pay dividends, do buybacks, and are trading at fair multiples. However, if you look at Amazon, you can see that they hardly do any of this. Amazon is trading at a 35 PE ratio, which might seem a bit expensive, but I believe at this price, Amazon is relatively cheap, and the reason being is because they're investing so heavily into growth. When we take a look at Amazon's fundamentals, you're going to start to understand what I mean when I say it doesn't appeal to the average investor. Looking at the total revenues, you're going to see that these are continuously increasing, which is very good to see. But what you're going to notice with this enterprise is they don't actually do any buybacks. If we take a look at the free cash flow, you're going to see it be a bit unpredictable. This is because this company is investing heavily in R&D. Pulling up the R&D or the research and development expenses, you're going to see that they are continuously increasing. This is simply because Amazon is still in its growth phase. It's a company that's very hard to evaluate on current metrics, and that's because it's just continuously growing and investing heavily into growth. All around, the metrics for Amazon are not necessarily bad. So you might be wondering what warrants Amazon trading at a 35 PE ratio. Well, it all comes down to Amazon's future growth drivers. We all know that Amazon operates in the e-commerce market, and this sector for Amazon is growing at around 9% year over year. But what a lot of investors don't realize is there's also the AWS or cloud sector for Amazon, and this sector is growing at around 18% year over year, which is significantly higher growth. What this means is the AWS sector is going to make up a significantly bigger portion of Amazon's business, but it also means that the margins of Amazon are going to significantly increase. And remember, currently Amazon's margins are really compressed because they're focusing so much on growth, but they're having this huge growth in the cloud sector, and this sector has significantly higher margins than the e-commerce business. So you're not only getting a sector that is growing a lot faster, you're also getting a sector with significantly higher margins. So you have the amazing AWS and cloud growth, but you also have Amazon, which is the leader in the robotics industry. So a lot of people don't realize this, but let me give you a bit of visual representation. This is what a normal Amazon warehouse looks like. You have people working in the warehouse, sorting out the packages that are incoming in the warehouse, and then these packages are delivered through Amazon's vans, and they're delivered usually same or second day with Amazon Prime, which is very fast delivery. Now, what Amazon is starting to do and is currently doing is they're actually getting rid of employees and they're starting to employ robots instead. So instead of having to pay employees, they could easily offset that labor to robotics and robots. And this is not only robots in the actual warehouses, it's actual robots that will be delivering the package. These vehicles could drive autonomously and deliver the package and be delivered at your doorstep with the help of robots. Robots could literally be in the vans, get out of the vans, and deliver you the packages. Now, this might seem a bit far-fetched and this might seem like a very hypothetical situation, but Amazon is actually in the research process of trying to develop a humanoid robot to do this job. There's actually a couple news articles written on this that Amazon is reportedly training humanoid robots to deliver packages. Obviously, this whole idea is many years out, but it's still important to consider if you plan on holding this company for the long term as I am. And this would offset a significant cost for Amazon. This means that their margins will explode if they don't have to employ human workers. And the next few growth drivers, I'm just going to sum up quickly. So first we have Project Cooper, and you probably all know what Tesla Starlink is, but Project Cooper is Amazon's version of Tesla Starlink. What Project Cooper is a satellite that provides high-speed data and internet connection to all around the world. What this does is it provides competition to Tesla, and it also is a new growth driver for Amazon. Obviously, it's not profitable yet, it's in the works, but down the line, I could see this becoming a very profitable growth driver. We also have Amazon's healthcare section, so Amazon is starting an online pharmacy. So instead of having to drive to the pharmacy, you could have your prescription medicine delivered right to you. I think this is something that should have been done a lot sooner, and I think it's an obvious growth driver and will provide extra revenue. And last but not least, we have logistics and delivery. And these are just some long shot bets like drone delivery or electric vehicle autonomous delivery. I feel like these will take a couple of decades to actually catch on. All around, I feel like Amazon is a great bet, especially if you want to position your portfolio to take advantage of the cloud growth and AI demand for data centers and everything AI related. I feel like Amazon is one of the best positioned robotic companies and is also a company that will significantly outperform the S&P 500 going forward. The next company I have for you is ASML. Now, you've probably also already heard this company being talked about a lot in the investing community. And it's for a good reason that these companies are talked about. It's because they are very high quality businesses and they're businesses that are very likely to outperform the indexes. But ASML is a bit of a special company to me because I call it a picks and shovel play for the AI gold rush. What this means is instead of benefiting directly from AI, this is a company that's going to sell the infrastructure and the things necessary for companies to provide AI to customers. Instead of going out and buying a company that is innovating in AI and is in a very competitive space, it's much better to buy the provider of the hardware for all this new AI infrastructure. And this is where ASML comes in. So what ASML does is they sell these extremely advanced machines, as you can see on screen. And these machines cost over $400 million sometimes. They use a special process called EUV technology to actually manufacture microchips. And these chips are used in pretty much anything from smartphones to AI processors. ASML specifically manufactures the machines for this process, and they sell these machines to other businesses like TSMC and Intel. Now, with the growth of AI and the demand for new processors and new microchips, I feel like ASML is positioned to benefit significantly from all these tailwinds. If we dive a bit deeper into the metrics of this business, you're going to see that this is a very high quality business. I actually own a significant portion of this company in my own portfolio. So it just goes to show how high quality this business is. It's currently trading at a 30.1 PE ratio. If you look at ASML's PE ratio over the past decade, you could see that it's trading at a relatively low multiple compared to historical averages. If we take a look at the revenues of this company, you're going to see that they are continuously increasing. Switching over to the shares outstanding, you're going to notice that they are starting to do significant buybacks. This not only means that the management is prioritizing shareholders, but it also might mean that the share price is undervalued. Switching over to the free cash flow, you can see that the free cash flow for ASML has exploded recently. Now, the return on invested capital is at a healthy 24.3%. Last but not least, the net profit margin is quite high at 28.3%. What you also might notice is the growth of this company is quite good, with a compound annual growth rate of 20% over the past 3 years. This company also pays a 1.1% dividend yield. So to conclude why I think ASML is such a good buy in today's market is for a couple reasons. There's a bunch of tailwinds benefiting this company in the long run, with AI and infrastructure increasing, the demand for chips increasing. Everything is going in the direction that is positive for ASML. And remember, ASML provides the machines for the backbone of AI. This company is providing the picks and shovels for the gold rush. This is combined with historical low PE ratios. ASML has dropped significantly over the past few months, and that gave it a very attractive price. Its PE ratio is at one of the lowest points it's been in the past decade. And something I didn't touch on much is the fact that this company is a monopoly. It's very unlikely you'll ever see a company with almost no competition in the market, but ASML is one of a kind. The only competition I could see is with China, but even China doesn't have the EUV technology just yet, and they're at minimum 5 to 10 years away from having this technology. So ASML is a pure monopoly in the market. All around, I don't think you could go wrong buying into a company like this and holding it for the next few decades. This next company I'm going to show you ties in very well with ASML. ASML sells the machines, TSMC sells the products. So TSMC is another company in the semiconductor manufacturing industry. This company buys the machines from ASML and manufactures the components necessary for certain companies. TSMC manufactures semiconductors for very large companies that you probably all know, like Apple, Nvidia, AMD, and even Qualcomm. What's so good about this company is, same as ASML, it's like a picks and shovel play during the AI gold rush. But there's a couple key differences that you may notice. First of all, TSMC is trading at a lot lower of a valuation. It's trading at a current PE ratio of 20.9. This enterprise is also growing at 22.3% over the past few years, which is faster growth than ASML. You will also see that the net margin is at 41.7%. Also higher than ASML. The return on invested capital is at a healthy 25.7%, and it pays a dividend yield of 1.9%. The free cash flow has been exploding recently. The shares outstanding also haven't decreased, which means the company is not doing significant buybacks. But all around, the metrics for TSMC are very solid. I would say they are arguably better than ASML. So to explain why I see value in TSMC in the market today, it's a bit of the same story with ASML. Because of the tailwinds benefiting AI and infrastructure and the demand for microchips in pretty much every technology we use, I feel like TSMC will benefit heavily from this growth. A question I get asked a lot is if you should buy TSMC or ASML. I would argue that there's no right answer to this question. In fact, I actually own both of these companies in my portfolio. If ASML does well, TSMC will most likely do well, and so forth. I would argue that ASML's moat is significantly stronger than TSMC's, but TSMC's price ratio is significantly lower than ASML, so it compensates for each other. I don't think you could go wrong with either of these two companies. Now, the next company is going to be Meli, or MercadoLibre. Now, this is a company that isn't talked about too much, but has been gaining popularity over the past few months. Think of this company as the Amazon of Latin America, except it operates in more sectors than Amazon does. Because this business operates in Latin America, it's operating in a very heavily developing nation, and this means that the price to earnings ratio and all the ratios are going to be significantly skewed because the growth of this business is just so big, and this business is reinvesting heavily into growth. Again, you have to think of this business like Amazon. The free cash flows of this business and the price to earnings of this business don't represent the intrinsic value of the business currently. So it's important to take that into consideration when evaluating a company like this. Before I speak of the fundamentals, I'm going to get a bit into what this business does. So this enterprise operates in a couple sectors in Latin America. The first one being is the MercadoLibre marketplace, which is their e-commerce platform. So this is a platform where online shoppers could shop online and order packages to their door, or could do their shopping online just like Amazon. And this sector makes up approximately 60% of their revenues. The other approximately 40% of the revenues come from Mercado Pago, and this is like a fintech platform in Latin America. And it's also what I believe the leading fintech platform in this region. MercadoLibre also has a couple other growth drivers, but these are very small percentages of the business, so I'm not going to be mentioning much of them. Now, going over some metrics, like I mentioned before, you're going to see that this company is very similar to Amazon. It has a very high PE ratio and a very low net margin. Now, I personally believe that MercadoLibre could have a net margin of around 20% down the line. However, this business is not currently focusing on profits, it's focusing on growth. And the growth of this business is just insane. The compound annual growth rate of the revenue over the past 3 years is 41.3%. If I pull up the total revenues on screen here, you're just going to see this growth be exponential, and it just continues to increase. This is the beauty of investing in developing nations. Now, if we look at the total shares outstanding, you're going to see that they're not currently doing any buybacks. And taking a look at the free cash flow, you're going to see it has exploded recently. But one of the most important metrics is actually the fintech revenue. What you're going to notice with this company is that the fintech revenue, which makes up around 40% of the total earnings, is growing significantly faster than the e-commerce sector. The reason this is such a good thing, and similar to Amazon's AWS sector, is that the margins of the fintech sector in MercadoLibre are significantly higher than the e-commerce margins. So this means that the fintech sector is growing faster, it's going to make up a bigger portion of the business in the future, and it also has significantly higher margins, which contributes to the profitability of this company. And this is why I think even at over a 60 PE ratio, this company is still undervalued, because they could earn significantly higher margins in the future. And if they stop completely investing into growth and they invest for profit and to make profits, they could earn probably a 20 to 25% margin. And that would bring down the PE ratio to 20-25 currently. But this isn't even the best part. The best part is if we look at this revenue quarterly and we go to the most recent quarter, you're going to see that the total change quarter over quarter for the fintech revenue is 5.7%. Which is very good growth. But if you look at the competitor, and NU Holdings is the competitor in the fintech sector in Latin America, NU Holdings, if we go to quarter over quarter recently, you're going to see that the net income, the growth was only 0.83%. So MercadoLibre's fintech sector had more growth than its key competitor, which is NU Holdings quarter over quarter. So I think that MercadoLibre is taking market share and clients from their key competitor, which is NU Holdings. So MercadoLibre is in a geographic region that is expanding. More people are using bank accounts, more people are creating bank accounts, and it's all around a sector that is having exponential growth and a developing nation. And then you have the benefit of AI and automation. Like I spoke about with Amazon, robots and AI technology could benefit this company significantly, especially in their warehouses and other locations. And you're also getting a business with a huge competitive advantage that is taking market share from its competitors. So all around, I think MercadoLibre is one of the best buys in the market today. Now, last but not least, we have what you probably expected, Google. So Google stock has ran up a bit recently, and I was actively buying the stock at around $161 a share. And that was when I was adding to my position in this company, and it makes up the second biggest position in my portfolio. The first biggest position being Amazon. And Google is the definition of a compounding machine, but people seem to be hating on this company, and I feel like it's a bit unfair to hate on a company when all of its metrics are going in the right direction. So this enterprise is by far the cheapest of the Magnificent 7. It's trading at a 19.3 PE ratio. Its compound annual growth rate of its revenue was 10% over the last 3 years. It has a net margin of 30%, which is very healthy. And its return on invested capital is at 30.9%, which is very good. Looking into its metrics, you can see that the shares are decreasing and the company has been doing buybacks, which is very good to see considering it's trading at a very cheap valuation. And if you take a look at Google's free cash flow, you could see it continuously increasing, which is one of the key metrics in a high quality compounding machine. So why is Google being priced at such a cheap evaluation? Well, it all comes down to competition in AI and the fear of Google search being taken over by LLMs. So Google search makes up over 50% of Google's revenue, and if that market share gets taken over by LLMs like Grok, OpenAI, or other AI technologies, that could be a significant drawdown to Google. Google could literally lose almost 50% of its revenue. Now, I made a video specifically on Google and explaining my thesis on why I think it won't be disrupted, but to summarize what I said is basically Google is one of the leaders in AI. As a matter of fact, Google just released their keynote a couple weeks back and proved that they are in the forefront of AI technology. They have the leading AI models, they have some of the best AI technologies, and they are not a company getting taken over by AI. It's very easy to make speculations and to hypothesize that something might happen on the market, but it's very important you look at the numbers and look at the fundamentals of these businesses. A business growing at over 10% year over year is not the sign of a dying business. When we look at the AI models Google is presenting us with and the new AI technologies, this does not look like a dying business at all. As a matter of fact, there's other growth drivers for Google other than search. There's Google Cloud that is growing exponentially. And Google Cloud is going to make up a bigger and bigger portion of Google. So even if Google search does start declining over the next few years, Google does have a lot of other growth drivers they could use to boost earnings. Google is no longer 100% reliant on search as they were years ago. Google is now a wide moat company. It's a company with a huge competitive advantage. It's a company that's extremely high quality, and it's the enterprise that has continuously grown extremely fast. I think Google provides significant value in today's market, and I think that the investors that stayed in Google stock and invested into Google stock and held for the long term will be rewarded significantly over the next few decades. I hope you enjoyed this video. Have a great day.